Gautam, now the leverage comes back to India. Now what happens? Overall macro picture, what changes now?
Hi, thanks for having me. So India's macro were anyways very resilient. I mean, we have been very strong on the macro front for some time now, growth, inflation, twin deficits, the way government has consolidated on the fiscal front over the last 3 years. Interest rates have come off. So I think macros were anyways very solid. This deal adds to the heft now because this was one missing piece. India was getting singled out on the trade front given the absence of deal with US. Now that in a week's time we've done the deal with both European Union and US, and on the US front we have moved from the most tariff nation to almost the lowest tariff nation. So clearly this removes a big overhang for the markets, not just equity but also the currency markets in my view. Second, I would treat this event more as an allocation event for global investors because the global investors have been underweight on India of late, especially the ones who manage regional money, the kind of underperformance that India has seen in the last 15, 16 months, and the way other markets outperformed us by a margin of 30 to 40%. There was absolutely lack of interest to look at India, given that our earnings had also slowed. So now the picture changes, and it changes for the better and substantially better because now we have corporate earnings also coming back. Currency will also stabilize and recover a bit. On top of that, the headwinds because of the deal on both stock market front, economy front, the jobs front, that dissipates. So from that angle, I think this is going to lead to a lot of reallocation in the portfolios, at least at the regional investors' portfolios level.
Yes, so there is going to be a reallocation, but let's ask about the sectors also, especially the export-facing sectors, like textile, auto ancillaries. Which are the sectors which are going to benefit a lot, and where do you see the risk-reward ratio favorable for the investors to enter now?
So look, purely on account of this trade deal, not many things changes from a bottom-up point of view because the trade deal has relevance for very few sectors which are smaller in size for the market. So you have textiles, something related to gems and jewelry, something related to auto hangs, and some durables and EMS here and there. But none of them are very big and material from a point of view of stock market indices. What, however, changes is the kind of the allocation angle that we just spoke about. Some of the bigger sectors also come into the play now. So financials, which is the most reasonably priced on risk versus reward, and not just banks, even NBFC, even the capital market-oriented names. We are quite positive out there on PSU banks, NBFCs, capital market theme. I think even consumer discretionary, we are very positive out there. We are underweight on consumer staples. In fact, we have a zero weight on consumer staple. Some of the sectors which benefit indirectly from this deal, I would reckon technology will come right up there, where we have changed the stance from underweight to overweight a couple of months back. And then there are a host of bottom-up mid-cap ideas which have been beaten down for one or the other reason. I think wherever you are seeing strong earnings delivery, market is ignoring even the stocks which are delivering good earnings. Now I think the picture can change out there, and you will have plethora of ideas to work with. The 15 months of consolidation has ensured that a lot of froth, even in the mid and small cap indices, has gone away. Not for a moment I'm implying that they are cheap. They're still expensive with mid cap at 27 P and small cap index at about 23 P. But the froth which was there in September 24 and early part of 2025, a lot of that has moderated. So you have enough ideas when you look at portfolio construction from a bottom-up perspective.
Right.
We are overweight on auto. We continue to like auto. What does this deal do insofar as portfolio allocation is concerned is that it removes the overhang and stops the derating which we had seen. In fact, on a relative basis, India has never been more cheaper versus the emerging markets.
That's a pretty interesting take on that, and just the request has come in that the Q3, the street was expecting some earning upgrades to come in from Q3, and largely we have seen a lot of good earnings also getting lost in the sell-off. So will we see that Q3 earnings upgrade coming in, or Q4 some of them will get shifted too?
So look, right now we are seeing the pace of earnings downgrade. That intensity has come off substantially in the last 3 quarters. We had put out a note also to that effect a couple of weeks back, and we are seeing that trend continue in third quarter too. almost 200 companies out of the 355 that we track have declared their numbers till yesterday. And they are bang in line with our estimates at about 13.5% earnings growth. The interesting nuance out there is large caps, after a very long time, are outperforming the mid caps on earnings versus expectations. Not that mid cap numbers are bad, just that the gap between the large cap and mid cap earnings growth, which is almost 2x for last year and a half, this particular quarter we are seeing that gap in the growth narrowing in favor of large caps now. And small caps, obviously, they
Right.
are having turnaround quarter after 5-6 quarters of earnings decline. But we are still not in earnings upgrade. We are still seeing moderate earnings downgrade. For Nifty, for the 31 companies for which earnings have come in so far, at an aggregate level, we have cut the Nifty earnings estimate by about 0.4, 0.5%.